Good evening and a very warm welcome to all the participants and speakers that have joined us for this online session on M&A Trends and Outlook in the tech services sector. This is the second edition of the report that we've undertaken in partnership with EY, and this report provides a very data-rich compendium of key trends in global tech services across all the three subsectors: IT services, business process management, and ER&D. We all recognize that we are in a period of very unprecedented change. When we started doing this report in November 2022, ChatGPT and generative AI was not a part of the conversation. Today, I think you cannot have a conversation without really talking about what does generative AI happen and what all the changes that it's bringing together. However, when we started the report, the focus at that time was really the global macroeconomics and its impact on industry and business, and what does that mean from an M&A perspective. I think in the last few months, what we are seeing is change that is now happening across multiple shifts, multiple sectors that we are seeing there, whether it's, the demand shifts from the industry perspective and its near-term impact on the industry, the technology shifts that I already talked about, and how do you configure the hype of generative AI and all the other technology shifts to its deployment. Are the tools in sync? The whole, the talent shifts from the period of the Great Resignation to now more focusing on in-demand niche skills. And of course, the geopolitical environment that continues to be volatile. In all these changes, the significance of M&A is critical, right? It doesn't change whether it's for acquiring new technology expertise, access to specific micro verticals or domain skills, tuck-in acquisitions or acquisitions for scale. You will see a wide variety of reasons why the acquisitions and M&A trends are happening, and what does that mean for your business? But as I read through the report, there are lots of different takeaways, but I just wanted to summarize my top 2-3 highlights from this report. One, 2022 was a year of robust deals across all the subsectors. And while you will see that Q1 of 2023 is more subdued with the global slowdown, M&A continues to demonstrate resilience. PE investment in the sector, which I thought was very, very high, continues to accelerate. Again, it's a reflection of the robustness of the tech sector and its agility in strengthening its core, as well as investing in building the new. Emerging technologies, particularly cloud and SaaS implementation, has been a key driver for M&A. This reflects maturity in both the specialist providers as well as the integrated providers in building specific offerings. Lastly, and most interesting, was the emerging trend in investing more in product IP-led solutions, which clearly can play a more key role in transforming the tech sector landscape. Without going into more details, I'd like to invite our partners from EY, Nitin, Bhatt, Technology Sector Leader, and Shivani, Nagpaul, Technology M&A Leader, to launch this report. Can we just request everybody to hold up the report, please? Thank you. And I'd just like to thank the team at EY and the Nasscom Insights team that has spent a lot of work in mining through the data, coming up with the specific insights, and really producing a report that has become a trendsetter on how does the industry look at M&A. Without much ado, I'd like to hand this now to Nitin for his welcome remarks.
Thank you so much, Sangeeta. Really appreciate it. And good evening, everyone. I'd like to begin perhaps by sharing with you some of the key highlights from our report. The M&A activity that we saw in 2022, as Sangeeta mentioned, was the highest that we've seen compared to what we saw over the last 5 years. We saw about 950 deals or so, and IT services comprised almost 85% of those deals. BPM was at about 10%, and ER&D was about 5%. Deal values stood at about $57 billion, which was 2x compared to what we've seen at the 2020 levels. The reason for this, as we all know, was an increase in digital spending triggered by the pandemic, as well as supply-side challenges due to the Great Resignation, and of course, the dearth of digital capital that we still see in the market. Interestingly, we saw distinct shifts in technology hotspots within the broader cloud and digital themes, as the focus shifted to building more specialized solutions across the cloud value chain, from strategy to migration to managed services. The buyer mix was dominated by strategics who accounted for about 65% of all deals. And within the strategic buyer group, what we observed was a number of first-time or unique buyers, and even a few placed multiple bets within a single year. The Ps led about 35% of the deal activity, including direct investments as well as roll-ups, which accounted for almost 55% of all deals. And 15 out of 23 large deals, about $500 million, were PE driven. Now, across all of this, what we observed was that the Ps focused their strategy on building specialized platforms and doing roll-ups into existing platforms. Maybe I'll spend a couple of minutes on the specific segments that we looked at. On the IT services side, there was a strong focus by strategic buyers on capability tuck-ins, focusing on hyperscalers, SaaS, cloud-based data platforms, as well as workflow management tools. We also saw digital native companies continuing to expand geographic presence and build vertical capabilities, specifically within BFSI. For the BPM segment, we saw a couple of key themes. The first was sector consolidation. We saw some mega mergers and deals aimed at expanding contact center services. Second, CX players acquired digital and experience design capabilities to drive nonlinear growth, and also focused on talent by acquiring multi-shore delivery capabilities. And finally, we saw large PE bets placed in revenue cycle management space as well. On the ER&D front, deal volumes doubled over 2020 levels. Strategic buyers again dominated the space with a 75% share over the last 3 years. We also interestingly saw a strong convergence of ER&D and IT services as ER&D players repositioned themselves as digital engineering companies, and tech services players looked at ER&D as an added growth engine, specifically in North America and Europe. In terms of themes, in addition to the focus on IP and product-oriented acquisitions that Sangeeta mentioned, we also noted a strong interest in emerging tech related to IoT, AR, VR. We saw low-code, no-code, metaverse, and ESG. And what's important here is that these were no longer buzzwords and were actually considered seriously for building differentiated offerings. Looking ahead, given the current macro environment and uncertainty, we are generally seeing caution. And even as M&A continues to be a strategic priority for differentiation and growth for most companies, people are being really cautious about the kinds of deals they look at and the kinds of valuations they consider. To delve deeper into how the M&A landscape may play out over the next 12 to 18 months, we're grateful to have really a terrific panel with us here today to share their experiences and insights. The discussion will be moderated by my colleague Shivani Nagpaul, who leads our tech investment banking team. Shivani, over to you, please.
Thank you, Nitin. Thank you very much. I am really delighted to introduce the panel members who have been very generous with their time to join us and share their views. I'll just request the Nasscom team to put on the slide, please. And as the slide comes on, I want to begin by introducing Catherine Stein. Catherine leads the corporate strategy and is a global leader for enterprise services and analytics at Genpact. In our understanding, Catherine brings a very unique perspective and has a vantage point of shaping the business for the long term, as well as understanding the ground realities of execution. So we're thrilled to have you, Catherine, and look forward to the session. Viraj perhaps needs no introduction. He's been investing in the TMT space and is now a managing director with Warburg and has been investing in the TMT space for I would say about 18 to 20 years now, and across the spectrum, be it tech services, software, consumer internet businesses, and he's seen the industry evolve through different cycles. So we're really excited to have you, Viraj, and to understand how you've seen the industry evolve, fight some of the challenges that have come up today, and what the road forward is. I'd like to then introduce Hiral. Hiral is the global CEO of Mastech. I've had the fortune of working very closely with Hiral, and what has stood out for me is his incredible approach he takes in terms of building a relationship with the acquired companies, creating a joint agenda for value creation, and how he's driving the inorganic strategy for the organization. Hiral, love to know what's next from you. Lastly, but not the least, Jayesh. Jayesh is the Deputy CFO of Infosys and Head of M&A. And what has always been, I think, my understanding of Jayesh is that he has a unique combination of really being detail-oriented and blending it well with the big picture. So thank you, Jayesh, for making time. And without further ado, I thought it might be interesting for us to just take a step back. In the report that you might have a chance to go through, we have delved very deep into what were the strategic drivers for the different industry participants, be it large tech companies, mid-sized, digital. We've literally gone under the hood to understand what are they doing and how each one's strategy is different. We've really covered that picture in detail up to December. Of course, some time has passed this year, and it only seems right to quickly understand what has transpired, because some of the macro trends in terms of the high financing costs, the macro environment has perhaps evolved since we analyzed the data. And if you look at this period, what stood out for us is that while the underlying drivers that really drive M&A, they still seem to be robust. There's a marginal slowdown in the deal activity. The deal values have dropped, largely because large deals have been lesser in number, and overall largely lower PE participation driving from the high financing cost and some of the macro headwinds. But overall, from a deal activity perspective, we believe that the underlying deal drivers for the market remain robust, which will drive the activity, which we saw with a lot of strategic buyers. It is moving to be a buyer's market. But if you see across the prolific buyers, be it digital native companies, Globant, for instance, or Endava, ThoughtWorks, across the globe, across the segment, I beg your pardon, they've been fairly active in this period. Be it the mid-market, the big four. So the industry participants, specifically the strategic buyers, continue to place some bets. We've seen some slowdown from private equity. I think as the financing market becomes a little bit more liberal and there's creativity around financing structures emerge, we expect this segment of the buyer universe to come back into the market. In terms of IT services, some of the themes that we saw play out in the prior periods continue to be dominant. One segment of the market, which is specifically BPM and CX, Nitin alluded to it, is actually seeing a significant consolidation, both for scale and to address the digital opportunities, as well as address the risks around commoditization. And we'll talk about this in the later part of the session as well. But one of the new elements that we're seeing emerge is divestitures and spin-offs. The focus for a lot of business seems to be simplification. The shareholders care about businesses which are focused on their core. And with that, we've seen some of the spin-off transactions being executed, and we expect this trend to continue. It just might be useful for us to just quickly, take a glance into what's happening from a valuation perspective, because the current valuation environment has had a significant impact on at least the deal activity and the appetite. A quick summary, we see overall at a sector level, the current valuations more or less seem to be converging at what they were pre-COVID, which to our mind reflects in terms of the high correlation between growth rates and valuations. What has actually been notable in our analysis is that the market now seems to be rewarding profitable growth, giving that a higher multiple compared to just growth, which is not as profitable. We've seen the gap between digital native companies to at least some of the others, which is the large global companies as well as Indian IT companies, that narrowing, where again we're seeing this phenomena play out. At least in the private market, we continue to see the market discern between really the best of breed assets, which are part of the digital continuum, and pay a scarcity premium around it. We expect that phenomena to continue. While the multiples will be a little softer, the differentiation between perhaps what might be the public market and the private market still might play out. We do expect in a market where the bid ask tends to be a little bit higher, given that we're coming off a very high valuation range in the past few years, a lot of creativity in the deal structures, both from private equity as well as strategics, to ensure that deals get done. With this little background, I won't take a lot of time, but dive right into requesting our panelists to share their views on some of the areas in terms of how M&A and deal making is expected to shape. I would like to request each of our panel members and really start off with a question, which is taking a step back. If you taking a step back, given that we're coming off a pretty record M&A activity and deal activity, I'd like to understand and from you as to what stood out for you. And the second question was, when you come off a high market with high valuations, very large, significant upfront payments, and which are predicated on really robust growth performances as well as projections, and we see some of that perhaps not play out. What are the strategies and opportunities or approach for value creation or managing shareholder value? Katie, I'll start off with you with two questions really, and what are your thoughts?
Sure, thanks Shivani, and thanks to EY and Nasscom for hosting us here. It's a really interesting topic, especially as we see a rotation right now in the markets, as you said. But stepping back, as you said, just to last year, it continued to be a very robust market. We saw some cooling down in private equity in the second half of the year, as you already mentioned, as interest rates slowed some of their capacity for buying. But I think that when I look at it, the tagline for me is still flight to quality. So I continue to see companies, and we did last year in digital services, that were growing in the 20 to 40% range and growing profitably. And those companies continue to have very strong bidding components to the transactions, and valuations in the private market remain, I would say, still elevated compared to the public markets. And so we see that that scarcity of capability is still playing out, especially as CX and BPM firms look to rotate their services more to digital services. When I think about, though, the payback, one of the things that we are richly engaged in, especially with some of our private equity holding companies, is really around thinking about operating margins and how in this period of time, especially some of these roll-ups and platforms stabilize and they wait for the markets to come back, hoping that the IPO market will open up next year. How do they think about structuring their cost structures and thinking about creating platforms where they can continue to grow profitably? And I think that's a new dialogue for many of these investments versus what we saw a year ago today.
Thank you, Katie. That's very helpful. Viraj, what are your thoughts?
I mean, look, I think the last 2 years were clearly unprecedented, Shivani. I think just looking as a potential buyer of assets at any stage in the last 2 years, you felt like there were at least a couple of $1 billion plus buyouts in the market. It did feel like every asset was finding a bid, and I think it was a little bit also a lot of the GPs in the private equity world felt like they needed to own something in the space, just given the growth that it was seeing. So you always had bids for pretty much all assets. I'd say it did help that the operating performance was heavily democratized. And what I mean by that is, last 2 years you really had a pull forward of demand. You can say that now with the benefit of hindsight, where growth was, as Katie said, 20 to 40%. But as we can see, it was a pull forward from the time we're going through now. But that helped a lot of people get over the line on saying, look, maybe some of this persists longer, and therefore you saw a ton of activity. Obviously, I think we'll have to see how the tide, as we move into this year, how the tide reverses and how good the quality of some of these businesses were. I'd say, look, on valuation, I think Katie said it, right? Like there is a flight to quality. I'd say even through the past 2 years, valuations were obviously, I think you pointed this out, went through the roof. Our own math suggests multiples went up 50 to 100% compared to pre-COVID, and deals were happening at those elevated valuations. I felt through 2022 or the back end of that, the macro had begun to change, but the multiples didn't really change. And maybe the deal activity fell a little bit. I'd say as I look forward, I think it's fair if you're a private equity buyer and you bought during the last 2 years, you're going to face some multiple compression, over a period of time. But I will say on the positive side, look, there's a lot of those were control deals. So I think, the destiny is in the hands of all of the owners on how they want to drive valuation or value creation. And I think to your point, I'd say M&A is going to be a very important part of that. I think, adding either capabilities, adding new customers, at a time when frankly concentration hurts, right? Like you're in an elevated risk environment. What if one of the big banks is your customer? Adding new delivery capabilities. So I think M&A will be an important one to drive differentiation, and I'm sure we'll chat more about that. But I want to say, I think in addition to M&A, and I think this is the point Katie made, it's going to be about operating improvement and cost out. We're seeing this in sort of portfolios globally where a lot of this is, well, if it's a year where you're not seeing a lot of growth, let's just make sure the operating margin remains protected. And, there are companies that are doing zero-based budgeting to do that. I'd say, look, as we look out on value creation, I think while there may be some multiple compression, I do think investors can, some IRR compression. Some people may still make good multiples if you hold assets longer. And I think, look, at the end of the day, these are still fast-growing industries, whether it's 5% this year or 10 or 15. I think long-term, the growth is there. So I think if you can execute well, I think you can really still protect the value of the investments made in the last 2 years.
Thank you, Viraj. Hiral, what do you think?
Thanks, Shivani. I think, first of all, Nitin and you provided a really solid summary in terms of last couple of years. So I won't take too much time. Building on what Viraj and Katie said, the deals were very fiercely competitive in some cases, right? Probably because of private equity infusion. And in many cases, we saw 20 shortlist buyers, move to 9, move to 5, 3, and 2, etc. Right? So we were obviously focused on very certain set of segments, but even within those, the competition was fierce. The 2022, while it did see some slowdown, and as we look forward, we'll chat more, but account mining will become critical because the ability to open new logos will have some sort of cautionary view. And so M&A as a strategy there, and even if you look back at the deals that were done in 21, 22, how do we leverage them more strategically for synergy, and how do we leverage them more for account mining? Those are the two things that have to be kept in mind as we look at extracting value, right? Because the growth rates might have been ambitious, but in some of the areas that we're talking about, CX, data, hyperscalers, the potential still exists to unravel or to leverage those capabilities for broader account mining. So I'll leave it at that for now.
Thank you, Hiral. Jayesh?
Shivani, I think a lot has already been covered. If I look at the way I was looking at it, post-pandemic, you had a situation where most of the companies had accelerated their digital journey, and Viraj kind of talked about having the demand which got pulled forward, right? But that led to why did that happen? That was because the clients were looking at digital journey of trying or moving everything to the cloud, doing deep data analytics, providing seamless experiences, and so on and so forth. And many of the companies had certain white spaces within that, and to capture that growth, that investment activity or the M&A activity really took off. In addition to that, we had few new players that came in. We had Big Fours coming and jumping into the bandwagon. We had the Japanese players coming in. We had Ps who had heightened activities. Some of the strategics who had never done acquisitions started getting into that space, and that also led to the valuation going up, right? Unfortunately, if you are one of those who paid that high or rich valuation, you would have baked in a lot more synergy. You would have baked in a lot more growth, in today's environment, when the interest rates have gone up, your DCF would not stack up, your synergies would not stack up. So you really have to strengthen that ask. You have much more ask from that perspective, right? To stack up that valuation. This industry is going to remain strong from that perspective. You have few years of ups and downs, but going forward, the growth is going to be really strong, and growth is strong, right? As Viraj was also alluding to that. So from that perspective, I don't think you'll have a challenge, but you may have some dips in between where you will have a challenge if you had paid up that high, ROI or high rich valuation from at the time of acquisitions.
Thank you so much, Jayesh. That is so well summarized as well. Switching gears, what we noticed when we looked at our data and we analyzed it is that a significant amount of M&A was focused on, especially in IT services, and I'm looking to cover IT services now, is around capabilities. And the capabilities were around the digital transformation value chain. Could be hyperscalers, could be CX, could be specific applications, etc. And this is a theme we saw across all buyers. So now we are at a point in the last 3 years or 5 years where a lot of the industry participants have created that capability. The question is, as you look at the markets, what will create that differentiation in the next 3 to 5 years, specifically where there are similarities of capabilities that we see across players. That was really what we wanted to talk about, Jayesh. And why don't I get started with you? Given your position in the market.
So great question, Shivani. If you look at this industry is all about adapting technology, right? 4 or 5 decades of this industry's existence. We have seen waves of technology coming in, and every wave is a new wave of technology. And the companies who are adapted that technology wave, the company who have been agile and embraced the technology are the ones who have really created value for all stakeholders, right? The only thing different this time around is, unlike earlier waves which were led by a single technology, this digital wave is a wave of multiple technology, right? You have cloud weaved in, you have data within that, you have cyber, you have IoT, and so on and so forth, right? The second important aspect, which is different right now, is the way the world is connected. The change is so rapid. The impact or the disruption in the marketplace is unprecedented, and therefore it's going to be very very interesting times. The only way to survive in this market to stay ahead of the game is through differentiation, right? We did talk about it even in the earlier question, but how do you differentiate, right? Differentiate in the ability to deliver end-to-end solution, right? From the experience to the application. Differentiation in having industry-specific solutions to the client, deep industry domain experience, and combine that with generative AI or immersive experience and things like that, full bundle together, right? Or differentiation not only in implementing what client wants you, but sitting with the client, strategizing them, guiding them in what they should be asking for, right? Because many of the clients today don't even know what they should be asking for. And if you are able to do all of that, I think you will be ahead of everybody else. So that's one part. The second part is all of the IT services businesses people dependent, right? Or people driven. How do we nurture our people? How do we repurpose them in this ever changing technology phases, right? How do we repurpose them? How do we empower them, armor them with the newer and newer technology solution skills and all of that, right? And I think that is what will set the company apart from everybody else.
Very well, Sajesh. I think the people angle is so important in this industry. And Viraj, as you look to invest and build portfolios, what are the elements of differentiation that you're looking for in terms of who will be the winners in the next 3 to 5 years?
I think somebody needs to unmute him.
Yeah, Nirmala, would you mind unmuting Viraj? So maybe what I'll do is, while we wait for the technology piece to get resolved, Hiral, I'll bring you in, and then we can go back to Viraj.
Sure. So building on what Jayesh said, there is 3 dimensions that we take a look at when we talk about differentiation. One is the differentiation as it relates to the platform itself. So obviously there's leading platforms, there's evolving platforms like Snowflake, Databricks, there's hyperscalers, but within those platforms, how do we further differentiate it versus spreading or diluting too thin, right? So it could be within AWS, is there a data cloud play? Within Salesforce, right, is there a marketing or analytics 360 play, right? So platform level differentiation, but going into the next level of depth, right? So that's point number 1. Point number 2 is the industry play, but even within industry, look at healthcare, but within healthcare, can you look at provider or payer or even pay providers, right? And build integrated solutions to the earlier point of how you can make it much more contextual for the customer in the context of that industry. So that's the second. And the third is, while I agree with both of you on the people angle, the ability to potentially integrate into some type of non-linearity, right, in terms of some level of non-linear solutioning would become important going forward. Yes, people will always be the heart of our business, but can you create some sort of non-linearity without full dependency on the people? So those are the three elements of differentiation, at least that we look at.
Absolutely, Hiral. We see a lot of focus on automation and the need to drive non-linearity. Viraj, I'll bring you in. We see your audio sorted. Apologies for that. As you look to make your next round of investments, what are those elements that you're looking for?
Yes, I'd say, surprisingly similar to what Jayesh and Hiral have said, but I'd say a few things, right? I think one is, I think the point they made around just being very sharp on what you mean to what types of clients. I think gone are the days when it's about cost arbitrage and, gathering clients across 5 or 7 different verticals, or even across multiple, service lines. So I think you have to be very sharp around, in that matrix where you play. Also enables a sharp go-to-market. So I'd say that to me is sort of one. I think second, and I think Jay said this, is really positioning yourself well for next-gen capabilities. I think in this industry, we see a tech priority refresh every 10 or 15 years. There was cloud, mobile, agile development started 5-7 years ago. It still has significant legs, but it's imperative now to identify what are those next horizons. Is it generative AI plus ML? Is it data, blockchain, metaverse? So where do you play? How do you build capabilities in those? I think the third is what Hiral said around non-linearity. I'd say just continuing to invest in your own IP as you achieve all of the above. I don't think services businesses transform into SaaS or software businesses, but I think how do you leverage platforms and capabilities to either enhance your own productivity or just enhance the solution you're selling clients. Fourth, I'd say is really a diversified delivery footprint. I think through the Great Resignation, it did feel like people who were able to access talent pools across different parts of the world just benefited. I know we created value in some of our investments through that approach. And while maybe the labor market is not as hot today, I still think we're in a generally tight labor environment. So I think just having access to the right delivery footprint and the right talent. And the last I'd say is, this is how I characterize it, sort of moving up the value chain from solving a technical problem to solving a business problem. And I think that's the point Jayesh was making. And maybe said it differently, but I think that end-to-end is very important.
Thank you, Viraj, and just to summarize, I think the focus on the end-to-end, going much deeper in terms of platform competencies, what Hiral mentioned, sharpness of what you mean to each of your customer segments, and holistic people strategy, I think are some of the elements that should drive. It's a combination of strategy and execution, as it always is, but a more sharply defined one. With that, I'll probably move to you, Katie. When you look at the whole BPM and the CX segment, what we see is a huge intersection of competencies around cloud technologies, automation, the whole IT or the build capabilities coming into managing processes, and a significant amount of investments. If you see the PK Global and Convergence transaction, for instance, or TELUS Willowtree, they seem to indicate that trend, and that's what we've been hearing. What does that mean for the industry? Are we seeing the convergence of tech capabilities and BPM capabilities? Is that what it means in terms of that convergence? Or each of the incumbents have their own play area and their own proposition of what they're taking to the client? How do you see it?
Sure. I think we're in what I consider a shift left moment with respect to organizations in the BPM industry who own the business process knowledge in the domain. And we heard that mentioned earlier, which is the understanding of the business problem, so the complexity of that problem, and shifting now into how we can use the tools of technology, data, analytics, and AI more and more on our minds to actually reconstruct those business processes. And so candidly, I see a significant need for the BPM industry, as we heard, to shift away from scaling of people in other locations and labor arbitrage to using technologies to deliver return on investment faster, oftentimes eliminating transactions as opposed to shifting transactions to other locations. Now, your question is, does that mean that we're all converging into the same buying centers? I think there is some overlap that naturally is happening. However, I think that when I look at our IT partners on the other side, there are clear advantages to scale plays where they're playing in the infrastructure side, where business process outsourcers would not be playing. And so I think there's actually adjacencies where we cooperate in the market, and obviously more playing fields where we'll compete. But to me, the strategic move is really taking that business process understanding and leveraging technology into it, as opposed to pure scale technology plays.
Thank you, Kirita. That's a very helpful perspective. Viraj, you've built Biftera, you're building some of those competencies. How do you think of this phenomena?
Not dissimilar to Katie's view. I think, look, there are many distinctions, I think, between the tech services guys versus the BPM firms that are making significant investments in tech services. The way I think about it is, the legacy tech or IT services were more focused on horizontal tech, covering infrastructure, DevOps, testing, over a period of time, building cloud and engineering and all of that stuff. But I think the focus was still more horizontal service lines with scale. I think BPM firms are investing in tech areas that enhance their value proposition of core BPM services. And I think that's the difference. So, for them, it'll be much more RPA automation workflows. I think front-end CX, you will see, the one acquisition that you mentioned. So I'd say that for the BPM folks, Katie knows this obviously, and her perspective is value more than mine, but I think the thesis and motivation is to drive better bundling integration of their services in a way that they're able to automate and eliminate things versus the traditional companies. The question, and I think maybe Jayesh will have a perspective on this, is I sometimes feel like the more traditional tech services guys still have tech services and BPM, and they haven't integrated it as well. So I think that would be an interesting space to maybe watch out for. I think they will both, last comment I make is I think both will play to similar trends in different ways. So if I take data, for example, the tech services firms will be up front and center doing a lot of the data engineering work. At the margin, I think BPM folks, given the data they have access to, can actually play a significant part on the analytics side of things. Now, obviously, there'll be all overlaps, but I think you'll see different flavors and, both types of firms coming at the same types of opportunities in slightly different ways.
Thank you, Rajesh. Do you want to add any flavor to it, because you have literally both of those competencies in-house?
Yeah, I think Viraj covered it well. Shivani, if you look at the BPM and tech, they are so close to each other. They are so adjacent to each other in so many ways. Whatever BPM is doing, if you just take out that as not seeing it as only a transaction processing, but look at it as a more value-added services, it automatically gets into data analytics and kind of services like that, right? So, but historically, BPM has never been doing that kind of transition, if I may, and then using tech enabled from that perspective to make that transition worthwhile. But if you have the tech and BPM housed in the same organization, you are obviously much more better placed to do that, because the one part of the organization already doing that, and the BPM team can actually leverage that very, very well. Historically, I remember once we were walking on a BPM floor, and we asked somebody how much of the payment processing goes through your account, and the guys were clueless because their focus was only to do the SLA and meet that. But I think today, if you look at that has changed significantly. The guys are really looking at how do you do and transition to more value-added service to the client. So it's again going back to from doing either a tech solution or a process solution to a business solution to the client.
Thank you, Jayesh. Thank you so much. One of the elements, and just switching gears to perhaps integration, we all recognize that a strong integration is important for successful M&A. Now, in a market where you're coming off large valuation, there's a bid-ask gap. One tends to get to deal structuring components that don't really fit well with integration that one might want to do. what's your sort of guidance or experience to all of us in terms of how should we think about it? And is a more mature approach to integration, is that a differentiation in terms of how buyer is perceived by the seller in a competitive process? So two really elements around integration, given that it is in a market where bid ask is still an issue and a reasonable issue. So if I just request Catherine, if you want to take that.
Sure. So the question is really around whether we're now in an environment where we need to mature our integration capabilities and whether that actually advantages a buyer. When I think about the transactions I'm involved in, we spend a lot of time actually during the deal cycle talking about, we talked about earlier, culture, leadership and talent, retention. Remember, you mentioned there were some product acquisitions or deals going on, but many of these are people acquisitions. This is talent roll-ups around hot skills, whether it's SaaS or cloud. And so when I think about what we've focused on doing is in those conversations, thinking about the integration of key go-to-market and how we'll drive towards the market synergies. And I find that that's really where we spend time during the deal cycle. Post-deal, obviously, there's the back office integration, but to me, if we can get the synergies accelerated in the first 6, 9, 12 months, the thesis plays out. And that's where we in our integration packet really spend our time, as opposed to, candidly, all the back office integration, which has to happen seamlessly, but can follow later on.
Right. But Katie, the challenge always is, when do you integrate and how do you sort of work out the earn-out and the deferred consideration models, because you're bridging a bid ask, which is right now pretty meaningful in the private markets. So yeah. How do you set yourself up to maximize on both of it? Is there a formula there?
Yeah, I mean, so we tend to, and I'd be curious to hear from my colleagues here on the call, we tend to stay away from earn-outs because we find them very complex to manage. And we find that actually it oftentimes leads to disincentivizing what we're trying to do as a company, which is strategically integrate the capability into our go-to-market and our clients. So we tend to try and move away from having someone focused on an earn-out where they may go choose to do that outside of our core platform that we're plugging these tuck-ins into. And again, I'll very carefully say tuck-ins because that's the type of acquisitions we've been focused on. And instead, where we, again, spend our time in the deal cycle is really talking about how we can create better potential for the leadership and the people of our acquired companies, as opposed to maybe a financial buyer or another strategic that wouldn't be looking at them as so central to everything they're doing.
Understood. Jayesh, what are your thoughts on this one?
I think, on a lighter note, Shivani, if you look at the diligence phase is like dating, right? And, post-acquisition phase is like post-honeymoon, right? The reality bites you only when the honeymoon period is over, right? But having said that, and I think we have a slightly different approach as compared to what Katie has been saying. And what I have seen in the market is most companies have a single approach. Either you keep them outside of the main parent entity, or you keep them completely, you fold them completely in the parent entity. I think what we have done at Infosys is a combination of all of that, right? At the time of acquisition itself, we define as to how and what stage of integration this is going to be, right? Are we going to keep this entity significantly independent? Are we going to, over a 2-3 year period, are we going to completely merge this entity, or are we going to keep it somewhere in between? And that pretty much defines our way of the structuring of the deal, right? If the entity is going to remain independent, then you can have an earn-out which is linked to the entity's performance. If the entity is going to get merged with the similar business of the parent entity, then you do a joint earn-out after a year of existence, or joint business earn-out after a year of existence, and so on and so forth. But I think integration is far more and beyond the earn-out problem itself. Earn-out problem will anyway go away in a year or two, depending on how you've done the earn-out structuring. But integration is going to remain most important for the success of the entity, right? And I think there are a couple of points that I would want to highlight that we look at it when we look at the integration plan. And the challenges that we have seen that facing us, right? First and foremost is, the expectation mismatch. what is the expectation of integration from the acquired entity and what's the expectation from our side. And if you are clear upfront about it, it helps both sides. For instance, for us, certain things are non-negotiable, and we tell them very upfront, the code of conduct or the FCPA or ASHI regulations or whatever they are. We tell them very, very clearly and set the expectations on that. We tell them the integration plan in terms of what and when we'll get integrated. So I think that alignment upfront is very, very important. Even if not during the due diligence phase, in the first few months of acquisition, that setting up is done very, very clearly. The second part is the cultural part, which I think Kathy also kind of mentioned. And how do you take care of that when a small entrepreneur entity is coming into a big ship like yours, right? And that's where we do a lot of sessions with leadership on both sides. We have simplified policies which we roll out to the acquired entities, which are much more simpler than what we are used to, right? We build trust through various initiatives, similar and so forth and so forth. The idea being that we don't want to take the entrepreneurship spirit from them while integration, right? Third part, I think, is on the integration per se, right? We've never tried to reach an integration model which is one size fits all. We have tailor-made integration for every entity. Over and of course, there is an overarching plan, but within that we've always tailored to an entity's requirement, right? And I think those are the ones which has helped us really well. Today, many of our acquired entities, CEOs or the leadership has taken up larger roles within Infosys, and many of them are brand ambassadors for the new acquisition that we go, and they are the ones who are going and telling them that this is the strategic player you want to be. You will still get the freedom that you want to operate in.
Thank you, Jayesh. Heral, any quick words? I think we have a lot of questions coming in as well. So I just want to get
good points already covered. So maybe incrementally building. So there's go-to-market focus, like Katie mentioned, but there's synergies which cut across both ways, right? So the acquired entity will have accounts, and you're trying to cross-sell to those accounts, and vice versa, where you have accounts. In this case, Mastek, we want to bring those capabilities to our accounts, and of course, there's some joint go-to-market. But I do believe, and this is not just a current view, but historically as well, that when you start measuring on EBITDA, which is important and critical in today's environment with operating margins, but when you start measuring the acquired entity only with that lens, it does delay integration, and it does create a little bit of a siloed approach in some cases. So it is, like Jayesh said, it is tailor-made. It is a combination of those things. The one thing I'll leave it at is that metrics of success of what you want to aim for, right? So if I were to look at some of these deals that we have done, it's really, a year or 2 years from the acquisition, are you seeing larger deals? Are you seeing more integrated average deal sizes increase? Are you seeing your accounts grow because of that? Are you seeing full end-to-end offerings? And I think some of those things, if you sort of clearly map out, it defines your integration success from a go-to-market perspective.
Thank you, Heral. And I want to get to one of the key questions that I think most of the audience here wants to hear. But Viraj, quickly from your side, how should one think of exits from a private equity perspective, especially with the public markets are lukewarmish? How do you think about exit strategies in this environment?
So just quickly, whether I have a slightly different take on the whole earn-out thing, and longer conversation, but I think there's a way to have your cake and eat it too. Our perspective is different because as a private equity fund, you're investing in smaller companies, not the scale of like a Genpact or Infosys. So I think it's possible even without a very set system to be able to figure out a way to have that integration, which is a little more people dependent at that scale. But the two mantras I follow is sort of thoughtful integration and generosity. And I think there's a way around just being generous with some of this earn-out stuff in a way that, these entrepreneurs who you're bringing in are actually very motivated to make it work. Again, longer conversation, but I think, there are ways to make both models work. So just different perspective. I'd say, look, on the, the market. So your question is, how do we think about exits in this market? Is that sort of what you're getting at?
Yes, absolutely.
Yeah. So look, I mean, it's quite an understatement to say public valuations are corrected. I think you said it. It's as if COVID didn't happen. Valuations are back to pre-COVID, some case lower, some case higher, but on average, that's sort of where they are. Obviously, it's it's growth. Companies that grew at 30% plus are now 5, 10, 15, pick your number. And even to meet near-term numbers not going to be easy given what we're seeing in this current quarter. So I think let's think about both for people who are looking to exit, public exits and private exits. I'd say on the public side, it'll be challenging. But I would argue that even at the best of times, Shivani, IPO exit wasn't the most optimal if you were a private equity fund owning a majority stake. It's easier in a minority setting, harder in a control setting. Obviously, there were some situations where the multiples were so amazing that it made sense. But I'd say for the most part, if you're a controlled investor, harder, even in good times. So I'd say when you're thinking about selling to a private equity fund or a strategic, I would say, it's hard today because there's a debate both on what the right earnings forecast is and there's a debate on what the multiple is. So, value is A to B when A and B are both a little bit up in the air. It's just hard to, sort of get a real alignment. So I think in general, for many companies where investors are seeking exit, I think it will become wait and watch just by de facto because the consensus on value may not be as easy. But now let me argue on the other side. Why might you still see deal flow? I'd say, look, there are places where investors hold quality assets that they bought pre-pandemic that are well in the money. And investors are, after all, in the business of buying and selling. I think value may still be a debate, but I think if it's a good business, you will see transactions. And I might add, you might still get surprised by what the winner paid. While your median bids may change, I have found in this space, there's always that one person who's prepared to sort of pay up. So I think net, there will be lower. I think you will see a greater fall off in deal flow than you will in multiples. So you will see a fall off in that too. At what pace and when it comes back, I think remains to be seen.
Thank you so much, Viraj. And I thought we'll, just get your quick summary views on how do you see any calibration of M&A activity, deal activity in the current environment? And we round off that questions and jump into Q&A from the audience, which are building up. Katie, may I start with you? What do you think is the outlook for the next 12, 18 months?
Excuse me, I was on mute. I actually see that there still is a lofty expectation of private market expectations with respect to price, and the prices are still rich. And that I think will slow some of the deal making. However, at the same time, we are seeing a very robust pipeline of companies who are continuing to test the market and understand. And I think that will actually accelerate as companies find that they're more strapped for cash. And it goes back to the conversation I had earlier around what they're focusing on this moment. These companies are investing for growth at a rate that's quite rapid. And so I would expect in the next 6 months, we'll continue to see quality assets come to market. From a buyer perspective, I think there were some very valid comments made with respect to how do we get comfortable with the valuations that are on the table. And so, I don't see the market necessarily slowing down to pre-COVID levels by any means from what we're looking at today.
Thank you. Thank you so much. Jayesh, what's your summary and rounding off comments on what the outlook is?
I think outlook, from the perspective Katie said, I think it's similar, Shivani, the valuations are coming down, but not still significantly. We are seeing opportunities in pockets. I think this industry will continue looking at the opportunities which are in terms of building capability gaps or, opportunities which are in technology, which are futuristic. What we will look at in addition to that is where you have more synergies, where you have capabilities in the market, because, for most companies like us, building capabilities in India is much easier. So capabilities in the market would be one key advantage. The clients where, if they're enterprise grade clients where there's an opportunity to upsell, cross-sell, that would be helpful. And of course, the cultural and management alignment on, that would be one of the most important things. But yeah, in terms of the targets would be capabilities, technologies, the industry solutions would drive most of it.
Thank you. Thank you, Hiral.
Yeah, so we think that in the current environment of the next few quarters, cost takeout and cost optimization will continue to have a lens, even when it comes to M&A. So even though we look at some of these leading edge platforms, how does that help get more ROI from the investments our customers have made? So there is a cost lens to it. There is an AI lens to it today, as Sangeeta pointed out earlier. You have to kind of look at the thought leaders, whether it's generative AI or use cases of generative AI in cross marketing, sales, other interesting areas that are evolving. But I think in the end, the fundamentals are still the same, right? You have to ensure the entrepreneurs, the CEOs of the acquired company, not just the founder, but also the team, the next level teams are seeing a path, are seeing the right kind of culture and making sure that they get the right roles, motivated to build and grow in the company. So if you sort of keep that fundamentals of value creation with the lens of cost takeout and emerging technology, I think we should be in good shape with M&A.
Thank you, Hiral. Viraj.
Yeah, again, my perspective is younger companies and businesses that we're trying to grow. I'd say, there's enough execution challenge on the organic side in today's environment. How do you eke out growth? How do you deal with margin pressures in this environment? How do you mitigate that? There are questions like, the generative AI, how's that going to impact your business model? How's it a risk? How's it an opportunity? So I think there's just so much fundamentally organically that you have to deal with. I think you could get very easily drawn into saying, look, there will be very good deals to be had, and should you just make acquisitions because you can bulk up, buy things at good value? I would say the bar should be high. That doesn't mean you don't do M&A. Absolutely, a lot of our companies are out there on the front foot, but I think we're just asking them to be very focused on making sure they don't let their eye off the road when it comes to the core organic challenges that exist. And I think therefore just having a high bar on what you want to buy, what price you want to buy it, and what it brings you.
Thank you, Viraj. Thank you to all the panel members. We have just last couple of minutes. I know Viraj and Hiral, you have a hard stop. Just a question that came up, and I just wanted to pose it to both of you before I let you go. Is having distributed workforce, do you think it's a disadvantage when it comes to valuation? How do you think about it? Just if I may pose that question to you, Viraj, to begin with, and then turn it over to Hiral.
I'll give you an example of, a portfolio company that ended up being a terrific outcome for us. I think very India-focused delivery, but serving a lot of fast-growing SaaS companies in the US on the West Coast. And given the agile, revolution that is sort of ongoing, a lot of those clients actually wanted LATAM nearshore capability. And I think the ability to integrate both of those and have teams that were across geographies actually ended up being accretive to value as opposed to destructive to value. I think you have to obviously be careful that you don't go overly distributed, and that can have cost implications. But I think it's a function of what your business is and what your clients want. But in many cases, I think distributed workforce can indeed be helpful, certainly as you're trying to also get more niche capabilities.
Thank you. Hiral, your thoughts?
Yeah. I mean, Viraj hit it on the mark. I mean, I think you got to make it work, and you got to integrate that into your overall operating model. There is certain advantages of having concentrated workforce, but then depending on the size and scale, I think there's some advantages with the distribution. It does also help, particularly depending on the model of your company with the different locations, etc., to further integrate and learn from each other. We've seen that as well, right? Maybe we acquired somebody who was in Chennai or Romania, etc., but then hiring those same capabilities in some other locations helped us. So yeah, I think people stress a little bit too much, in my opinion, on distributed workforce. If you make it work in the operating model, I think that's the best way, and there are some advantages to it, like Viraj.
Thank you. Thank you. I think we're getting to the top of the hour. We have a lot of questions. We'll probably try and answer them separately. But I did want to thank the panelists for making time. We are in interesting times, and it requires a recalibration of thought process and approach. and that will determine the winners. So your insights are very useful in terms of how does one think through one's approach. I'd like to thank Nasscom for this opportunity and look forward to continued interactions. So thank you so much for making time.
Thank you.
Thank you all.
Thank you.
Thank you.